NS India. I hope you can see my screen. You can see my screen and hear me as well, right? All good? Can you hear me? Yeah. Okay, so I'm just sharing the screen. I'm taking the NSE India website. Click on live markets. Over here you see something called as option chain. Option chain, go to equity derivatives. So over here, this is something what we call as option chain. Each option contract is having a strike price. So what are the current price of the index Nifty 50? 11,877.45. And the variation of each strike price is by 50 rupee. 11,850. The next strike price is at 11,900. So guys, strike price and all just don't get screens not visible. What about others? Maulik, if you're using the mobile app, I would suggest you to click the first link and attend the session using your web browser. Just don't look at the mobile app. Okay. So what is happening over here is, use browser, use the web browser. Okay. So strike price. What is strike price? Like what we mean by strike price is the price that we expect the index to reach. The price that we expect the index to strike. So right now the level is 11,877.55. And the left side, what you see are the table for calls, and the right side is the table for puts. Okay. So before I go further, let me just give you, I'll send you the recorded version. Before I go further, let me give you a simple introduction about call and put. Okay. When I say call, so call is a contract, it's an options contract. So call is our CE. Can we judge the trend using the chart on NCC? You can judge the trend of anything using the charts, but the accuracy it keeps varying. Okay, so when I say I'm buying a call with strike price 100, what I'm going to do is I'm getting into a contract. I'm getting into a contract with a person, and I expect the price of the contract to go. Sorry, the price of the particular underlying asset. The underlying asset can be anything. So let's assume that it is the shares of stock A. So I'm purchasing an option contract from a person who is selling it at a strike price 100. So to get this contract, I'm paying a premium. So maybe the premium that I'm paying is maybe 20 rupees. Abdul, if A has 100 shares, he gives 50 to B and 30 to C. And B gives 30 to D. Then volume will be 110 or 80. Okay, great question. If A is having 100 shares, he gives 40 to B and 30 to C. If A is giving 50 to B and 30 to C, the volume becomes 80. Okay. If A is entering into 50 contracts with B and 30 contracts with C, the open interest is going to be 80. So first scenario, both the open interest and the volume are both 80. Now, C is selling, C and D gives 30 to D. Okay. So now C to C and B gives 30 to D. Okay. So B is giving 30 to D. So now the volume is added by another 30. So the total volume becomes 80 plus 30, that is 110. Now what about the open interest? Open interest is still the same. Open interest is going to be 80 itself, while volume becomes 110 because the number of existing contracts is still 80. Right, number of contracts is still 80. So the open interest is going to be the same. Now let us assume that now B gives to D, right? Now let us assume that D is purchasing a contract. D is purchasing a contract from F. D is purchasing 1000 contracts from F. Now the open interest becomes 1000 plus 80 because that contract was not existing earlier. That came into place now only. So another 1000 comes in. 1080 is the new open interest. Okay. So when I say I'm buying a call option will be having a strike price and I will be paying a premium. In case the price goes near 100, the premium keeps increasing. So I bought it for 20. Now when the price is reaching 100, maybe the premium has become 50 or 60. So I bought the call option by paying a premium of 20. If new sellers are coming, then open interest increases. Those sellers are what we call as call writers or put writers. See, this is a very broad area. This derivatives, it's a very broad topic. Okay. So they are called as call writers and put writers. And most of the foreign investors, right? They are call writers and put writers. So the person who is selling this contract, right? So the person who is selling this contract is a call writer because a person who is selling a call, yeah, I'll give you the record. B would have bought from someone else, then the open interest would remain same. If B would have bought the contract from someone else, the open interest is remaining same, obviously. But F have bought it from someone else, the open interest would remain the same. But if F and D are getting into fresh, that is what I meant by fresh contracts. They're getting into a fresh deal that was not existing earlier. Then the open interest will increase. Exactly, right. So over here, somebody who is selling this call option, somebody is writing a call, he's selling a call with strike price 100. So he is receiving a premium for selling this. Okay. And Indian markets, everything is cash settled. Okay. So he's paying a premium of 20 rupee. Somebody is paying a premium of 20 rupee to purchase this call contract. So if the price is reaching 100 rupee, the premium keeps increasing. And if the price goes above 100, it increases exponentially. It can reach maybe 200 rupee as well. The premium can reach maybe 150 rupee, 200 rupee. So somebody who bought for 20 rupee, if the price goes above the strike price, okay, if the price goes above the strike price, he's going to have an exponential growth in his investment. And do you guys know what is the maximum risk that he is taking? What is the maximum risk that he is taking in this contract? Let us assume that over here the one lot size is one quantity. Exactly. So 20 rupees is the maximum risk he is taking. But he is having a potential to have unlimited profit. The premium that he is paying is the maximum risk. If the price goes above the strike price, that is going to be the change in premium is going to be his profit. Okay. So that is what we mean by a option contract. Okay. Call contract. And there's a person who is writing this call. And similarly, when we say about a put, let us assume that the price of the price of the underlying asset, the price of share A is 120 rupees. So if we are writing so if he is purchasing a put contract, when you are purchasing a put, we expect the price to go down. So I am buying a put. Buying a put means maybe I'm paying a premium of 20 rupees. And the strike price of the put contract is 100 rupees itself. So I expect the price to go down. If the price goes down below this, I'm going to have unlimited profit, exponential growth in the premium. And something that I bought over here, I can sell. If the price goes down, maybe it is going to come down to 150 or 200. I can sell it off at 200. That is my profit. Maximum risk I'm taking is 20. Okay. But now it might seem so simple to you guys that if he didn't sell before expiry, your broker will square it off for you. And there's something called as decay. That is like as you hold your it depends once again, it depends on the asset you're trading, underlying asset that you're trading. It varies. 2000 rupees is good enough for whatever option contract. Okay. And depends on the strike price. Lot of factors. The broad see, agenda of this meeting is open interest and market depth, right? So let's, okay. Yeah, so let me just share my screen. Let me just go back. Okay, so over here we can see different strike prices. So at strike price 11,900, the open interest that we see open interest that is existing is 2,600 and sorry 2,634,675. That is the number of active contracts that is existing at a strike price of 11,900. So this is the number of active contracts for calls. Calls means these many contracts are existing where these many contracts are there where the price is expected to move above 11,900. These many contracts, these many contracts are existing in the market where people expect the price to go above 11,900. And now looking at the put side, put table, we can see that 2,425,050 contracts are existing. These are put contracts. So these many contracts are existing where people expect the price to go below 11,850. So these many people expect the price to go below 11,850. Okay. So what do we see over here? What do we see? Do you guys see over here the open interest at the price of 12,000 is 3,833,000, and where do you find there is maximum open interest existing? Maximum number of contracts are existing at what strike price? What do you guys see? Just answer. At what strike price do you see maximum number of active contracts existing? 11,900, the open interest is 2,634,000. While when it comes to 12,000, the open interest is 3.8 million. So which is greater? Okay, over here the expiry date was 31st October. So let's switch to 7th November. Okay. Oh, yeah. So where do you guys see maximum number of contracts existing? Just look at this table now. Which table do you see maximum number of active contracts existing? 12,000, right? So maximum number of call buyers, that is maximum number of call buyers, they expect the strike price 12,000. While look at the number of in the put table, where is maximum open interest existing? Any idea where is the maximum open interest existing in the put table? Where the maximum open interest existing? Obviously, the answer is 11,800. So 12,000 is the upper limit and 11,800 is the lower limit. Okay, so 12,000 and 11,800. So what we can expect is when it came to call, the level was 12,000. The strike price was 12K. Call options. When it came to put options, the strike price was 11,800. Okay. And before we proceed further, see today's session actually mainly we are having because Josin is here. Josin, no. So today's session about open interest actually the recommendation given by Josin is actually he is from Hedge Equities, he is associated with wealth management team of Hedge. They are handling a big amount of capital. They have a team of maybe 20 members for just doing the technical analysis and fundamentals and all. Okay, so what usually happens is all the people who have the big money, people who have a huge capital, in the sense like the foreign investors. Okay, the foreign we hear about foreign investors in the Indian stock market. So all the people who are foreign investors, like who have the big money, the big fund firms, okay, all these firms, the type of contracts that they take, they sell call options and they sell put options. That is, they're call writers and put writers. They basically do options writing. Options writing meaning they sell these contracts. They sell call options and they sell put options. And do you guys know like why they're just selling? Okay. I would have to low risk, unlimited risk. When it comes to writing call options, it is unlimited risk. See, when I say I'm going to purchase a call option with strike price 100 and I'm paying a premium of 10 rupee, I'm paying a premium of 10 rupee, strike price is 100. Yeah, we can write options, but you need a huge capital. Strike price is 100 and the premium that I'm paying is 10. If the price goes above 100, my profit is unlimited. But the maximum risk I'm taking is 10. Over here, I'm getting unlimited profit, right? So this unlimited profit to increase offer interest of a strike price as they rule. I'll come to that. Okay. So to get this unlimited profit, somebody should be getting unlimited loss, right? So there is somebody over here who is writing a call option at 100, who is call writing at 100, and for writing this, he is receiving a premium. So the maximum money that he is going to get is this premium, 10 rupee. And if the price goes above 100, he is going to bear unlimited loss. Okay. If the price goes above 100, this call writer is going to bear unlimited loss. Okay. So the person who buys the call is going to get unlimited profit, while the person who is going to write this call is going to get unlimited loss. But uh, so what do you guys feel? Writing a call or buying a call, which is better? Buying a call will give you unlimited profit, limited risk, while writing a call will give you unlimited risk and limited profit. Writing calls, yeah. Is it like, yeah, exactly? It is like selling insurance only. When it becomes large scale, see, look at vehicle insurance. There are 100 people buying cars, only one or two will crash. Okay, so it's like an insurance only, but they, okay, are not complicating much things. Okay. They will be having the underlying asset also. So for them, they are not keeping their assets. Okay. So Srinivasa is saying writing is always better. Okay, and so happy about this answer. So what is going to happen over here is most of the times what usually happens is the market always favors the writers. That is 12k is the upper limit. See, I'm not telling always 100% cases, but most of the times, if these are the levels where the contracts maximum open interest is existing, we can expect the market to be within this range only. That is, at the time of closing, the market is going to close somewhere between 12k or 11.8k. Because the call writers, put writers, how is the premium decided? Lots of factors. Depends on the expiry, depends on the current price. See, I'll just show you. See, over here, if you see, the premium that is associated with the, 11,850 contract is 113.15. Right. Now, the premium that is associated with the 12,500 contract, just see what's the premium, 1.8 rupee. The premium that is associated with the 12,500 contract is just 1.8 rupee. While the premium that is associated with The 11,200 and 11,850 contract is 130. Can anyone answer why? Can anyone answer why? Don't answer at the money, in the money, out of the money. Okay. Yeah, exactly. As the probability decreases, the cost will be lesser because uh, 12,050 is like so far away. So the premium is like 1 rupee. And another thing what I have said is as the price reaches the strike, as the price reaches the strike price, the increase in premium will be exponential. If this is 100, the price moves above price of the underlying asset share A goes to 101. Maybe from 99 to 100, when the price changed from 99 to 100, maybe the increase in premium was just 10 rupee. Now, when the price changes from 100 to 101, maybe the increase in premium is by maybe 25 or 30 rupees. Okay. So the premium keeps changing exponentially after the strike price. See, this is a very big, very broad area. So let's go back to open interest. Okay. So, when we're looking at the open interest over here, the maximum open interest for what do you say? Maximum open interest is lying for calls 11,000 1.4 million, that is 12,000, and for put it is 1.34 million, that is 11,800. So we can expect the index to be in the range of 12k to 11,800 because most of the times the market favors the writers. Yeah, you'll be able to trade. See, you are no longer beginners. Okay. Yeah. And have you seen this? Like people who start off with options, they stick to options only. One reason is that see, options takes a lot of time to study. See, have you seen any MBBS doctors working as artisan? Karthik, are you a doctor? Have you seen any doctor who is working as a uh, okay? Have you seen any doctor who is working as a musician or someone like that? No, because they have taken a lot of effort in studying, and they really don't want to stick out of it. Okay, but if you're looking at engineers, you can see engineers who are film actors. You can see engineers who are musicians. You can see engineers in all the fields. One probable reason is that they haven't taken much effort, so they might not have even studied anything. Okay, they just got the degree somehow, so they don't mind learning some new skill or doing some other kind of job. So similarly, people who do options properly, they just stick to options because it takes a lot of time to study. Once you master it, it's more than enough. I'm more into equity side, not into options. Okay, and I implement option strategies, but that is limited risk, limited profit. Okay, so we're just going to back to the topic. So we can expect the price to be within this range, and I have mentioned this point that the market, most of the times, the market favors the writers. That is, favors the people who have returned the call options, who have returned the put options. And one reason is that these are the people with big capitals, and if they want, they can continue. That is like they can actually drive the market as well. They're capable of driving the market, and most of the times see, let's assume that let's take of Yes Bank. Let's take Yes Bank. It's taking too much time to load. Okay, so the people who see for equities too, there are this options contract. It will show just like your equities will show negative quantity, it will show positive quantity. But like if you have lesser than 8 lakh rupees in your demat, when it comes to Nifty, Bank Nifty and all, like you can't write any options. You can just buy. So if you're short selling 100, that is if you're what is it? Sorry, not short selling. If you're buying a contract, you can cover it anytime. Okay. Actually, what is happening is you are selling of that contract to someone else who's willing to buy. Your open interest is still remaining the same. You are not building any fresh contract. You are exchanging it with someone else who is willing to enter the contract. Okay. And since these writers that we were speaking about, they are the ones who have a huge capital with them, and they are capable of making driving the markets as well. So if you're looking at Yes Bank, I don't know why this is not working now. Okay, so if you're looking at Yes Bank, or whichever stock you're going to trade, whichever stock you're planning to trade, what one can do is you can find the range where maximum open interest is existing. That is in the call side and the put side, where the range is existing. So these ranges can tend to act as resistance and support. That is, you can usually find a range bound moment between these open interests. If you're asking me how effective it is not that much effective when you're trading equities, because we are looking at the short term support and resistance levels. And however, knowing where the maximum open interest is existing, it will give you an idea how the movement for the stock is going to be. So if you have seen Josen's message, like his text about Yes Bank, his answer was based on that. Because the call writers and put writers, if I'm a call writer who wrote a call at 100 rupee, if the price is going to go above 100, I'm going to go in unlimited loss. And I'm somebody who has a huge amount of capital with me. So if I'm going to reach a situation like that where the price of A is going to go above 100, that is above the strike price, I'm going to go in unlimited loss. What I'm going to do is I'm going to short sell. I'm going to short sell, or else I'm going to short sell future contracts, or I'm going to short sell in the direct spot market. I'm going to short sell a large quantity. So this will drive the price of the underlying asset down. See, options contracts, the price of options contracts are dependent on the spot market. That is the price of the what do you say? The price of the excuse me, yeah, the price of the, like when we see the Bank Nifty options or the Nifty contract, it is dependent on the underlying Nifty index, right? So if I'm able to influence the market in such a way that I'm able to bring the price down, if I'm going to short sell maybe a huge quantity in Yes Bank so that it drives the price down, and I'm saved from getting into unlimited loss. I'll do that. I can do that, right? Because if I have a huge amount of capital with me, instead of going in unlimited loss, what I can do is I can drive the market down. So most of the times, market favors the writers. Another thing, I can actually exchange the contract with someone else. I can exchange my position. And let me tell you something else that I personally do. So if you have an underlying asset, that is, let us assume that for a Reliance, if I have like 1,300 shares of Reliance, okay, or whatever, like the lot size, okay, forget about quantity. I have Reliance shares with me, okay. Let's not take Reliance. Share A, the price is 100. Right now, the price is 100. And under this market condition, the price is not moving that much. So, what I can do is, I know that the maximum, like looking at the levels, looking at support resistance levels, 52-week high, looking at all these things, looking at the global market conditions, I feel that the price of the stock is not going to go above 110. I feel the price is not going to go above 110. So what I'm going to do is If I have the underlying asset with me, I can write a call. I can write a call with strike price 110. So when I'm writing a call at 110, there will be somebody else who will be speculating that the price is going to go up to 110. So he will be paying me a premium, and let's assume that he pays me a premium of 30 rupee. He's paying me a premium of 30 rupee. I'm receiving that. I'm writing a call with my underlying asset. So in case the price is going to go up above 110, I told you, right, I'm going to go in unlimited loss. Okay, if the price is going to go above 110, I told you I'm going to go in unlimited loss. But if I have this underlying asset, I can actually see call is actually what is call? Is it an obligation or a right? Okay, so if the price goes above 110, yeah, exactly, Sharad. I'm hedging my position right now. Exactly. Right, that's the right answer. Okay, you call it as hedging. Okay, so if I feel instead of keeping my assets ideal, I feel that the price is not going to go above 110. If it goes above 110, who is making a gain? Okay, Satish, call is nothing else. We expect. Let me not confuse too many things. Satish, like if you didn't get it, it's perfect. We'll have separate sessions for this. So please. Okay, yeah. So now what is going to happen is that the person who is going to pay the premium, no, I'm receiving the premium from him. Okay, I'm receiving this premium from him. So Satish, one basic thing. Let us assume that I have when I say a call, there will be a strike price for this call option. If the price goes above the strike price, I'll get unlimited profit. So for you, it is no loss, no profit. I will be in some small amount of loss, very small amount of loss, but that's not so considerable. Okay. So in case, even if the price goes above the strike price, I have received this premium 30, right? And I have the underlying asset. So I will be pledging my underlying asset for writing this call. So what is going to happen is that this 100 shares will be like what was earlier 100. The price has gone above 110. So that profit that I make over here will be nullified by the premium that the unlimited the loss that I'm going to take over here. So it is going to be swapped over here. So that is why this big people who have fund firms, hedge fund management firms, all these people, they write calls. They do call writing and put writing because instead of keeping the assets, so till 130 the writer is safe. No, the writer is safe. See, obviously, he won't see exponential increase means something that goes up like this, right? Maybe somewhere over here still he is able to cut. He is able to get out with a neither loss nor profit. But if the price stays below this only, he's getting this 30 rupee, right? If the price doesn't go above 110, he's going to get the 30 rupee by doing nothing. Else, what would have happened? It might have reached 105. So he got a 5 rupee gain and the premium that he received. Okay. So this is what you like. This is what we say by writing calls with some underlying asset. See, this is something next level. Since you have asked, I have told. So that's the reason. That's the underlying principle why market is favoring this call writers and put writers. If the if they have written call over here, okay. And let me tell you another thing. They have written call over here. Price is going to go above this. If they want, they have enough money. They can pump in a huge capital into this, bringing down the price. Okay, and the kind of money that you require for writing a call is somewhere around like 300 times more than the no 300 more than that times more than the amount that you need to purchase a call. So selling a call and selling a put needs money. Okay, so we diverted a bit. Okay, I don't know why. Okay, yeah, S Bank, this thing has come. Let's see the option chain. So now let's look at the option chain of Yes Bank. So the maximum number of active contracts is existing at 60 rupee, 3.3 million contracts. Okay, this is 31st October again. Okay, over here we have seen the maximum number of contracts that is existing is at 70 rupees, 7.1 million. And this side, the maximum number of contracts that is existing is at how much? That is, yeah, that is still at 4.6 million. Okay, yeah, sorry, it is over here, 7.6 million maximum active contract. That is a strike price of 80 rupee. And the next one, what is this? Yeah, at a strike price of 70. Okay, so now you see that at the strike price of 80 rupees, the premium is 5.3. If the price of the underlying asset reaches 80, maybe the premium is going to change to 8 rupee. So from 5 rupee, the premium is going to change to 60. Oh yeah, it's at 60. Sorry. So call side maximum open interest is existing at 60 rupee, while on the put side the maximum open interest is existing at 70 rupee. Right now the price of the underlying asset is 70.3. So what do you guys feel? How is going to be? How is it like? How the price is going to be tomorrow? Hey, no, it's at 80 itself. At 60, I'm really sorry. At 60, the open interest is just 4.4 million, while at 80, the open interest is 7.6 million. At 80, the open interest is 7.6 million, while at 60, the open interest is 4.4. So 80 is the strike. Yeah. So we can't say this. We can. Yeah, it can be bullish. It can be within this range. Okay, it can be within this range that the price is going to travel tomorrow, and the open interest can keep changing as well. Okay, so the open interest can keep changing as well. So now we'll just go to the PPT. So whenever a volume we had discussed about open interest. Now what happens is that when the price of a stock is keeping rising, price of the stock is keeping on rising. The open interest that we are going to mention over here is about the future contract. See, now we have seen open interest, it keeps changing. Nothing specific. If you look at the chart, you can see. Okay, now see, right now till now we were speaking about the open interest of the options. So this will give you an idea about how the range within which the price is going to be. Okay. Now we'll just see how like some basic things. These things are not loading. No why? Okay. Now for even for future contracts, there is open interest that is existing. Okay, there is open interest that is existing for future contracts as well. And okay, so let's do something. Let's wind up the session for today here. We'll have a continuation tomorrow. Okay, we'll see about futures tomorrow. So let's stop with yes, like options today because I guess it'll be too confusing. Srinivasa, Sharad, you guys, Sayan actually he felt bored that he left. Yeah. So see, people who are already into this options thing, they'll be familiar. But for people who are getting started with it, it's too confusing. Like you will get confused. Why are we doing futures? Because why are we doing options when we can do futures or equities? you'll get to understand that only once you start doing it, because according to theory, these are just contracts, but it's something more than that. There are like lot of factors like VIX, volatility, open interest, lot of things that comes into play. Okay. So with that, we'll wind up the session for the day. So before that, like, can I just show you something? Like, can you just mark this down somewhere? Can you take a screenshot of this? Just see this. Like, see this with the futures open interest. Futures open interest, you'll be able to see on the right side. We'll see tomorrow. If you can't find out, perfectly fine. We'll see tomorrow. Just take this down. What else? Just take a screenshot. I guess you're done. Okay. Yeah, started with futures and finished with option. Yeah. So, uh, yeah. So I guess you guys have got an idea about. See, we diverted a lot. The reason is that we got many questions in between about C, P, all these things. Okay. So about market depth, that will do now itself. So coming to market depth, I don't know why this is loading. So I hope almost everyone has got an idea of what is open interest, what is volume, how it is going to affect all these things. Like, if it is fine for you, we'll continue. We continue a bit more. Yeah. Okay. So now let's see something related to open interest. Okay. So over here, this is the future contract of Tata Motors, 31st October expiry future contract. And over here, the volume is how much? 3, 3, yeah, 54 million, 54.7 million. And look at the open interest. Open interest is 13.8 million. Open interest is 13.8 million, while volume is 54 million. Okay. So you can see open interest over here as well for future contracts. So whichever stock, like if you're looking at the Nifty 50 stocks, you can see future contracts associated with them. You can see the open interest. You can see the number of active contracts that are existing. You can look at the option chain. So there are two things I would like you guys to do. That is, first thing, have a look at the option chain of the stock that we were talking about. Like whichever stock that you're going to look at from Nifty 50, have a look at its option chain. Okay, it might not be active. The open interest won't be so high. Then no use in doing. But doing the best thing about this, like you can look at the open interest of Nifty, the overall index as well. So we can see where maximum number of contracts are existing. That can also be done. Fine. So just have a look at that. Now, next thing, we are going to learn about is how open interest volume, how it can, like how we can kind of get, like this is not so accurate, but we'll be able to kind of understand what does volume and open interest indicate. What does a racing volume and accompanied by a racing open interest indicate? What does a decreasing volume accompanied by a decreasing open interest indicate? Okay, so I'm too exhausted for the day, so I'll just discontinue over here. Fine. So thank you. Good night, guys. So we'll continue the next day. So I'm just ending the session over here. Just watch out for Yes Bank tomorrow. Okay. Good night.